A very good morning, everyone. In the last video, we saw the basic concepts of risk, uncertainty, the difference between them, and the meaning of perils, loss, hazard, what can be considered as financial risk and what can be considered as non-financial risk. In this video, we will be talking about the risks that are faced by financial institutions. Now, financial institutions and the risks that they face are significantly different in nature when we compare it with a manufacturing company or a service company. Right? The risk that is faced by HDFC Bank might be very different from the risk that is faced by Reliance or Tata Consultancy Services or TCS. This is because of the inherent nature of financial institutions, as they have to deal in various types of financial securities, right? They have to deal in financial assets day and night. Their bread and butter comes from dealing or transacting from various sort of financial services. And this makes it particularly challenging for any financial institutions to manage their risk efficiently and effectively. There are many instances where financial institutions have been destroyed because of their lack of solid risk management. Most prominent example is Lehman Brothers, right, who was declared bankrupt in 2008 global financial crisis. The most recent example that we have faced was Yes Bank, right? We have many instances recently that have been considered as a very good example of poor risk management practices by financial institutions. The bankruptcy of banks in US like Silicon Valley Bank, Signature Bank are also solid examples of why risk management for financial institutions is must and needs to be considered extremely seriously. Right? So now let us look at the various risks that are faced by financial institutions. The first type of risk is credit risk. So what is credit risk? The meaning of credit risk is the risk to earning or capital arising from obligors' failure to meet the terms of any contract with financial institution or otherwise failing to perform as agreed. The simplest example is of a borrower. Say, for example, I have a home loan. If I fail to pay the EMI on my home loan, it results into a credit risk for the bank. This is because I have not been paying or I have failed to pay my obligation as a borrower. The bank faces the risk that they may not recover the entire amount of money that they have given me as loan. Another example is someone has failed to pay the decided amount or determined amount to someone else for any asset that they have purchased. I have put up a simple example here, which says that Mr. A failed to pay the decided amount to Mr. B for the house that he purchased. What is so specific about credit risk is it is most recognizable risk associated with banking. Any activity which results into obligation for someone, right? When there is an exchange of money, especially which is specifically attached to financial institution, there is a probability that it may result into credit risk. Credit risk is found in all activities where success depends on counterparty, issuer, or borrower performance, right? The example of Mr. A not paying to Mr. B is an example of counterparty credit risk. If I have invested in debentures or bonds of a reputed company, and if the company fails me to pay the regular interest payments, then it is a credit risk for me as an investor because I might have to face some losses. The third is borrower performance, where borrowers who have taken any type of loan fails to pay regularly their equated monthly installments to the financial institution. Right? Credit risk is more wider than we actually understand, and it is right associated with most of lending activities. Now we move forward. The second is interest rate risk. Interest rate risk is the risk to earnings or capital from movements in interest rates. Right? Say, for example, that I have a factory and I have taken a loan of 1 lakh rupees at the interest rate of 8.5%. Now, if the interest rate rises to 9.5%, I will have to pay more. Similarly, say for example that a bank has given a fixed rate loan to Karthik at 9%. Now, if the interest rates in market rises, the bank may have to lose on additional interest that they might have earned if it was a floating rate loan or a variable rate loan. This is also an interest rate risk. Banks and financial institutions are the biggest recipients of interest rate risk because they inherently deal in financial securities, which includes debt securities, where interest rate risk is the highest. The third one is liquidity risk. In simplest words, liquidity risk is the risk that arises when financial institutions are unable to meet their obligations when they are due. Right? So the example of Silicon Valley Bank is a very fitting example over here because it failed to pay its investors on time. When investors started withdrawing, when depositors started withdrawing the amounts that were deposited in Silicon Valley Bank, it resulted into a liquidity and ultimately solvency risk for the bank. This is one of the most elevated risks that any financial institution, especially banks, face in their operations, and they have to be constantly vigilant on the liquidity conditions in the economy and the markets. It also arises from its inability to recognize or address changes in market conditions that affect the ability to liquidate assets quickly with minimal loss in value. And this is what has happened with Silicon Valley Bank. Silicon Valley Bank had adequate money with them, but it was invested in the form of bonds. Now, when investors or when depositors have started withdrawing huge amounts of money, in order to liquidate those deposits, Silicon Valley Bank had to sell its bonds at a very discounted price. Now, this resulted into higher losses for the bank, and ultimately the bank failed. Liquidity risk is one of the largest risk that any bank faces, and they have to be constantly aware. The third one is market risk. In simplest words, market risk is the risk in the value of an investment because of adverse movement in market or market risk factors. Right? If I have invested 5,000 rupees in shares, and if the market behaves or performs badly, and the value of my shares decrease, then it is a market risk. Standard market risk factors are interest rates, stock indices, commodity prices, foreign exchange rate, real estate indices. Say, for example, that Indian rupee depreciates. Now, this can be a very good factor. This can be a pushing factor for exporters to export more as they gain more. But importers have to lose because they have to pay more. This is a particular example of market risk. We now move forward to foreign exchange risk. It is the risk to earnings or capital arising from the movement of foreign exchange rates. And this is more particular for financial institutions that deal in cross-border investing, right? So multinational banks or financial institutions that have their operations in multiple countries face huge foreign exchange risk. And this is one of the highest risk factors that resulted into huge losses at times of uncertainty or huge volatilities in markets. A bank may lose on their capital if the currency, if the other pair of currency moves adversely. And banks need to be constantly aware of changing foreign exchange dynamics as per the geopolitical or global events. Another one is operational risk. This is one of the highest probable risk in any financial institution. While this is common for any sort of organization or an institution, this risk is much higher in a financial institution. Operational risk is the risk of losses incurred by inadequate internal process, people, systems, or from external event. Right? Because of faulty or lack of sound internal processes, a fraud may happen. People might also indulge into fraudulent activities. Systems, hardware, software might also crash because of inadequate arrangements. This is where problem really starts. The example of Punjab National Bank is a fitting example of operational risk where there was no integration between SWIFT system and the core banking system of the bank. The recent example of UPI, Unified Payments Interface, and its servers crashing, which resulted into no payments being processed, is also an operational risk. HDFC Bank was once involved in an operational risk where their phone application, whether it was in iPhone or Android phones, the application was not working properly. And they were also faced with huge penalties for the same. This is also a type of operational risk example. Businesses can experience severe operational risk when they have poor management or also flawed financial reasoning. Right? The recent example of IndusInd Bank indulging into shady accounting practices is also an example of operational risk where people have not disclosed the information correct. This is the risk of failing to succeed in its undertakings, and it is based on internal factors, right? So operational risk is mostly on the internal side of an institution. Right? While there are many examples, the classic example remains the Punjab National Bank scheme of Nirav Modi and Mehul Choksi, which resulted into huge losses, tens of thousands, around 12,000 crore of losses for Punjab National Bank, just because of one simple mistake where its foreign exchange messaging system known as SWIFT was not integrated with its core banking software. Another one is reputation risk, and reputation risk is the risk to earnings or capital arising from negative public opinion. Right? Say, for example, I am selling biscuits. I am a national brand selling biscuits. If there is some fault in my biscuits because of any issue, there might be a negative public opinion on the quality of my biscuits. And this might also result into fall in sales, fall in profits, or in fact, huge losses for my company. This is what reputation risk is. Another example is of Maggie, where they were involved in using lead and MSG in their product, which resulted into huge reputation risk for Nestle. This also affects institutions' ability to establish new relations or continue existing relationships. It can also expose an institution to litigation or court cases, financial loss, or damages to reputation. Volkswagen also faced a reputation risk as they were involved in scamming, or not scamming, but they had changed the emission from their cars. It resulted into huge reputation risk. They have faced billions of dollars in penalties and have also paid the same. Right? Reputation risk exposure is present throughout the organization, and that is why financial institutions have to exercise abundance of caution in dealing with their customers and community. Reputation risk is something which cannot be gained easily. Financial losses can be recovered. Reputation losses are much tougher, sometimes in fact impossible to recover. So institutions need to take care of the risks that they are facing. So that's it for the day. We will be meeting in the next series of videos, and we will be carrying forward the basics of financial risk management in the next videos. Thank you for watching. Have a nice day.